Hey traders, welcome back. Obviously, Twitter is a stock that's been in the news a lot as of late with the Elon Musk takeover news. We are going to be putting I think, unique setup on this trade in our live trading room on Tuesday. And I wanted to share with you some of the ways that we look at that and what we're seeing in terms of potential. All right, I said Tuesday. I think I misspoke. It is going to be Thursday that we have this scheduled for our live trading room. This is going to be one of our bonus trades that we're going to be putting on. And it's always an interesting trade. It's always an interesting setup. I always like talking about stocks that are in play and the opportunities that they may or may not represent. But whether the trades work or not, you always, I feel, have a little bit clearer idea of maybe what to expect and how to play that expectation. And so I want to talk about that a little bit here with Tesla, or excuse me, with Twitter. Tesla on the mind with Elon Musk. So obviously there is a little bit of a Tesla connection here. We'll talk about that here in just a second. But let's talk about what's happening with Twitter right now. Let's give a little overview for those of you that are not fully up to speed. It is one of the most interesting setups in a stock right now because it is in play. And I love the idea of stocks that are in play. We'll take a look at the chart here in just a second and talk about some of the movements that we've seen here. But back in the 80s and 90s when I was on Wall Street, today they are politically correct in calling themselves shareholder activists. But back in the day, they were called raiders. They were called corporate raiders. Or LBO specialists, leverage buyout offer specialists. But whatever you want to call them, this is people that are just trying to take over a publicly traded company, almost always in an unsolicited manner here, which is what happens here. So we've got a stock that's in play that always presents an opportunity. Again, it doesn't guarantee a profit, but it always presents an opportunity. Now, Elon Musk has an accepted offer on the table from the board of directors for $54 a share. That's the offer that he submitted. That's the offer that was accepted. It's about a $44 billion investment or cost involved there. But Twitter, of course, now is sitting around $36 to $39 a share. I'm filming this May 22nd, Sunday evening. It's been bouncing around between $36 and $39 a share. That's obviously got a 40% implied potential gain in it. The difference between, let's say $38 a share and $54 a share. There's got to be a reason why there is a 40% potential gain in there. Well, there's a lot of reasons. Number one, it's pretty clear at this point that Elon Musk has issues with his offer. It doesn't necessarily matter, I guess, to us whether it is simply cold feet that he's had on the deal. He's talking about the issue of bots. Twitter says that they've got maybe 5% of the accounts are fake or spam or bot accounts. And Elon thinks that it could be as much as 40% of the total activity on Twitter. I would tend to believe that it's probably higher than the 5%, being someone that's on Twitter a lot and seeing that action. But he thinks that that's obviously going to throw a monkey wrench. He didn't do any due diligence on this offer before he submitted it and it was accepted. The other issue that's obviously in play is that he is using a lot of his own Tesla stock as collateral. Tesla has been collapsing in this market like so many of the other tech companies have. And so he has, quote unquote, said that the deal is on hold. Put the deal on hold. Well, Twitter has come back and said nobody has the right to put the deal on hold, that they are already contractually obligated to each other, that there is a breakup fee of $1 billion in place right now that Elon will be liable for should he just walk away from the deal. I'm sure that, there's other issues involved as well. We already have class action shareholder lawsuits as we speak being formulated and put into place. against the takeover. There could potentially be some regulatory issues that come into play. We don't know about that yet. But all of these sort of cloud events sort of create this sort of $13 billion gap in valuation. That's the difference between where Tesla is trading right now and where it should be trading theoretically at $54 a share, which is what Elon is expected to buy it at. So we can see a lot of this action if we take a look at the chart itself. We can see that actually for quite a while here, Tesla has been in a downtrend. I think it's fair to say that for as ubiquitous as Twitter is, or excuse me, I say Tesla again, Twitter. It's been in a downtrend for a while and is ubiquitous and just, omnipresent that it is as a company and as a product. I think it's fair to say that it's not been well managed. The profits, the growth, any metric that you would choose to use to measure the performance of Twitter from a fundamental standpoint is pretty negative, to say the least. That's being sort of kind. And that's been reflected in the stock price. This was a stock that not too long ago was a $70, $75 a share stock. And it drifted all the way down to the low $30 range. And then we got this bid from Elon, and it pushed it up for sort of this consolidation range that it was in, maybe around $37, $38 a share, somewhere in that range. And we got the bid, and then the next day we hit that magical $54 number that Elon had put his takeout offer in, and then we immediately gave it away. Now, this was the first sign that something might be amiss. Again, back to the 80s and 90s with the corporate raiders, when my time was on Wall Street and you would see these bids take place, you'd see a bid for 54 and the thing would pop back up here to say 63, which is where it was trading before. And then you would actually have the board of directors, from their fiduciary requirements, go out to Wall Street and solicit competing bids. And you might see the darn thing pop all the way back here to 75 again. The fact that Twitter not only couldn't hold the $54 bid price of Elon, but the fact that it gave it back meant a couple of things. Number one, there probably was a lot of speculation that there was going to be financing issues or cold feet issues with Elon Musk. And number two, certainly doesn't look like there's going to be any white knights stepping in on this trade to try to outbid Elon Musk. In fact, it looks like, at this point, he has overpaid. So the question is, where does the stock go? It's obviously given all of that gain back, and we're right back smack dab into this consolidation zone. Might be an area that you would say Tesla would be fairly valued at if there wasn't a bid in place. Well, there's one of two things that's going to happen here at this point. We know for a fact one of two things is going to happen here. Elon Musk is going to follow through, and he's going to complete his bid, and the stock's going to get taken out at $54 a share. Again, that's that massive 40+% upside potential that we are talking about. Or he is going to commit to walking away from the deal, getting hit with $1 billion breakup fee, plus probably some litigation on top of that. But at this point, that doesn't necessarily look like a bad option for him. And you say that would be crazy to take $1 billion penalty, $1 billion hit on that. But keep in mind that the price of Twitter right now is $11 billion away from his offer price. And that's a big discount, or that's a big, overage to pay. I think most of us, as crazy as it sounds to take $1 billion hit, most of us, if we put $1,000, let's take a few zeros off of this for you and I's real world numbers. If you and I put $1,000 non-refundable deposit down on a car, and the day we went to pick it up, we realized that we were overpaying by $11,000, that we could go down the street and buy the same car for $11,000 less. As distasteful as it would be, the right thing to do, the probability would lie in us letting them have our $1,000 non-refundable deposit, walking away, paying $11,000 left, and we still come out $10,000 ahead. Elon may be thinking the same thing, but the point of our trading setup here this week for Twitter is that one of those two things was probably going to happen. The board is going to hold his feet to the fire. He's going to have the financing in place. He's going to feel that the pressure is not great enough, maybe on his Tesla stock that's being used as collateral, that he'll follow through and he'll take the stock out at $54 a share. We'll see this massive upside. Or he's going to pull his offer. And I believe if he pulls his offer, this is where we're trading, obviously, right now, this consolidation zone. I don't think we fall to here. I don't think we fall to here if he pulls his offer. I think you fall much, much lower. So the question is, how do you set up a trade for a binary event like this, where he's either going to follow through and it's going to spike back up to 54, or he's going to pull his offer and the floor is going to fall out from underneath Twitter? Well, let me show you what we're looking at. So there's a couple of ways that you could play this, and probably the most straightforward, first of all, obviously you've got to pick a time frame that you want to look at on the trade. And with options, of course, the further out you go, the higher probabilities you have, but the more expensive the trade becomes. I do think that I would probably be looking at something like these August 19th options. I think that would give you plenty of time to adjust the trade if the deal goes nowhere, which I don't think it would in the next 90 days, the next 3 months, but you may be sitting on this trade for 30 days, 60 days, 90 days even, before we really get a sort of directional bias in the trade in terms of what's going to happen. So I'm going to go out probably 90 days on this. This would be like the August 19th expiration date, actually 89 days to be exact. And one of the things, of course, that you could do, again, Twitter right now, this is Sunday evening, May the 22nd that I'm looking at this. We're right around $38 a share. Well, one of the easy things that you could do is you could just buy a long straddle on this. And you could do, well, it's at 30. I mean, if you wanted to be really precise, you could do it both at the money, which 38 is close to being at the money right now. And you could do that. And that would give you an opportunity to make money either way. Whatever Tesla did, if it went up to that 54, so this would be about a $985 trade, about 43% probability of success. And if we hit that 54, you'd make about $600 or $700. You could make $800 on the trade if it happened earlier than expiration. So, anywhere between $600 and $800 you could make on this trade could easily be a 70-80% return potential. And then if the trade does fall apart and we went below 27.50, which I believe that would be the potential of this. We're at 38 now. 31 was the low. 31 was where it was trading just not that long ago. And so I think being below 27 would be an easy opportunity to get some upside down there as well. Again, it's about a $985 trade with about a 43% probability of success. But we want to try to improve this a little bit. So one of the things that we could do is basically turn this into a long iron condor, admittedly at the money, but it would be maybe more like an iron butterfly, if you will, but we could turn it into a debit trade, debit spreads. And maybe let's come back here to our table. Again, remember the numbers on just the straddle. We'd be putting up about $985. You would have the potential here, if it did come through again, to make a 60, 70, 80% return on your capital. I don't know how low it would go down here, but you'd be nicely profitable there as well. Very similar risk graph down on the bottom, about 43% probability of success. Okay, so let's go back into the table here, and let's now say, well, you know what? What if we could cap the gains on this a little bit? Maybe increase the probabilities of success, maybe lower the capital requirements on the trade. That might be a way that we could approach this trade. So I was looking at the 55s up here, selling the 55 strike price calls, and down here on the put side, selling the 21s. I believe that was the number that I was looking at. And if you look at that now in a risk graph, whoops, did I do that wrong? Let's go back and make that a sell. And this should be a sell. There we go. Okay, now if you look at that in a risk graph, you can see that some of the numbers have changed. So obviously, we have capped our profit potential on these now by selling the outer wings. The inner, bought the inner, sold the outer wings. We now cap our profit potential. Our profit on the upside would be about $700 on a $900 investment. It'd be about an 80% return potential. It would be very close to the same number down here on the downside, about $700-800 on the downside. And this might be an approach that a lot of people like. This now is about a 46% prob. Doesn't really change your probabilities too much, but just a teensy bit lower on the capital because we brought in a little bit of income on the upside. So if you, there's a lot of our traders in our trading that like this setup. This setup particularly appeals to them. And that might be something that we do put together as we do this trade this week. Again, we're probably targeting Thursday in the live trading room to put this on. But here's a little amendment to this that I actually really like. So let's go back to the table now, and I'm going to change these strike prices up just a little bit. I'm going to come in here and I'm going to do a ratio trade on this. I'm going to take these 55 contracts here and I'm going to add one. I'm going to add one extra contract. There we go. Add one extra contract to that call side that is a sold one. And I'm going to do the same here on the bottom. I'm going to add an extra contract to that. You'll see that it does bump up my my requirements just a little bit here. It takes me to about $1,300 on the trade. But if we look at it in the curve now, now you can see that this trade, again, about a 45% probability of success trade, only $1,300 of capital committed to the trade, and a pretty nice profit margin anywhere in here. If we hit around that $54 a share, you could actually even slide this down a little bit. Take this from 55, it looks like, to maybe 52. That's going to bring in a little more income, and it centers this a little bit closer to where the potential deal would fall. I want to have that peak of this deal a little bit below the $54 price because even if they come to terms and Elon says it's all back on, financing is in place, no issues involved, it's going to not sit exactly at 54. It's going to sit just below that. There's always a little risk that a deal doesn't close until the deal closes. So that 52.50 would be a nice top of the tent for me. That'd be about a $600 profit, be about a 50% return on your capital outlay. And sort of the same thing down here on the downside. I think that we would have probably some downside potential all the way down to around $21 a share on Twitter, and that again would give us a nice potential return, almost $800 or $900 if you hit the tent perfectly, but basically the same profit potential as on the call side. So this is a setup that we're going to be looking at doing. It's an interesting setup. We should be doing this in our trading room on Thursday. If you're interested in cool trading strategies or ideas that are maybe a little bit different like this, if you are interested in taking a look at our live trading room, we've got a free 1-week trial. And when I say free, it's absolutely free. You don't pay a penny for that. There's no cost to get into the room, get live access for 1 full week. And then if you allow the trial to move into a full subscription, we give you a very, very ironclad double your money back guarantee in that first month. I will click a link down here, or I will input a link down here below for you. Number one, to sign up for the free trial if that's something that you're interested in. And number two, give you a link to the video talking about the requirements for the double your money back guarantee. Yeah, we do require a few things of you. You do actually have to participate in the trading room. You have to have an accountability meeting with myself to make sure that you're actually following the rules that we give you. But if you're all in on trading, it shouldn't be a big deal, and it gives you a very easy entry, low barrier of entry to try our trading room. So let me know how it goes for you guys this week. I'm excited to get back in the trading room with you. Talk to you soon.